In this week's video, we'll review the latest charts, data, and coronavirus projections to gain a better understanding of why, despite the relentless declines, stocks may not be out of the woods yet. It's relatively easy to forget that in last week's video on Friday, March 13th, the Dow had just surged 9% in one session. You may remember we covered this chart in last week's video and said this is somewhat of a mixed bag here. Not the best looking candle, still finished the week down 8%, but it was impressive that the market was able to rally and close back above an upward sloping 200-week moving average. If we fast forward 1 week, the final stats for the three major indices, S&P down 15%, Dow down 17.3%, and the Nasdaq down 12.64%. It's likely that many market participants have thought to themselves in the past few weeks, I've never seen anything like this. And that is accurate. Sentiment trader, this is the worst 5 weeks ever for global stock market investors. And unfortunately, at this point, we really haven't even seen the economic damage relative to making its way into earnings reports. This is open table bookings, restaurant reservations, year over year, down 95% on average. We're going to expand on these concepts, so let's quickly recap. We just experienced the fastest 18% drawdown in stock market history, fastest bear market in stock market history by a wide margin, and typically something that takes 29 to 30 weeks to occur just occurred in 3.4 weeks. Thus, we've heard the word unprecedented numerous times in recent weeks, without previous instance, never known or experienced, unexampled or unparalleled. Mark's Twitter handle is here. He works in institutional money management. By our reckoning, the 14-month advance from December 24th, 2018 to February 19th, 2020 is the shortest cyclical bull market in post-World War II history. What is a cyclical bull market? A cyclical bull market happens after a major low. This is a cyclical low in 1987. This is the bull run. Thus, all of the things that we saw and covered after this low here, we have never seen an advance this short before a bear market. And that dates all the way back to the end of World War II, which is the period shown on your screen. Not only was this advance off of this low the shortest in history, but that was followed by the fastest decline in history. Shortest cyclical bull in history, fastest bear market drop in history. Once again, we're using that same unprecedented term. Now let's jump right into the most important topic from this week's video. We've been covering credit spreads on short takes. You can find this post by Googling the title here. It's dated March 17th, 2020. In recent posts, we've highlighted here where my cursor is that this ramp is very, very rare in credit spreads here. And reaching this level here is rare as well. Recently, the only other cases, 2016, 2011, 2008, and the year 2000. Has anything changed? The answer is yes. This is the height in credit spreads for each one of these instances. And it might be helpful to answer this question. Have spreads in the present day exceeded the maximum stress readings in the 2011 and 2016 cases? The answer is yes. Thus, from a probability perspective, we're starting to discount the 2016 case and discount the 2011 case, and we are moving closer to the 2008 and year 2000 cases. We have data going back to 1996. Spreads have reached these levels only on 2 other occasions. Date number 1, November 30th in the year 2000. Credit spreads 9.06. Monday, September 15th, 2008. Spreads 9.05. Wednesday, March 18th, 2020, 9.04. Therefore, it might be helpful to know, how did stocks perform walking forward from this point here and this point here, which is similar to Wednesday, March 18th, 2020? Chart of the S&P 500. This is November 30th of the year 2000. And after spreads popped above 9, really bad things continued to happen in the stock market. This is November 30th of the year 2000. The S&P 500 peaks in March of the year 2000. So it's pain, hit this level, and then additional pain, significant additional pain. This number here is in addition to the loss in the rearview mirror here. It's 40% from this date here to this low, which was in October of 2002. How about the 2008 case? Monday, September 15th, 2008 is similar to March of 2020. What happened walking forward in the stock market from this date? Very similar and painful outcome. The additional loss was 43.28%. When we were performing this research, and I put my cursor on this point here, and Monday, September 15th, 2008 came up, it made my stomach hurt. Because something noteworthy happened on Monday, September 15th, 2008. That was the day that Lehman Brothers declared bankruptcy during the financial crisis. And after Lehman declared bankruptcy in the financial crisis, really bad things continued to happen. So the moral of the story for us, as long as credit spreads remain elevated, we should err on the side of caution. Our current allocation already reflects this type of uncertainty and risk. But if spreads remain elevated like this on counter-trend rallies, we're going to have to sit on our hands until things calm down from an evidence perspective. That's true in the credit markets, and that's true in the stock market. This graph from Reuters outlines similar concerns. Name companies with debt issues going on in the present day. It's good for us to keep in mind that after the financial crisis, it was pretty much widely accepted in central bank circles that they made a mistake letting Lehman file for bankruptcy. And thus, just as we have seen over the past few weeks, we can expect them to throw everything they possibly can at the market to try to stop something similar from happening. That may be difficult to do in the context of the present day. If you've been involved with the markets and investing for a long period of time, you may find these stats surprising. You would think if somebody came and tapped us on the shoulder before the close on Wednesday, February 19th, 2020, that was the last day that the S&P 500 printed a new all-time high. And they told us what the future was going to look like. You would think that if you moved your entire portfolio into TLT before the market closed on February 19th, that you would have absolutely killed it. That's not the case. This is ETF performance from the close on Wednesday, February 19th to the close on March 19th. Look how tepid these numbers are. First of all, out of these ETFs, and we follow 235 ETFs, only a handful of them are profitable. And look at these tepid returns. Even TLT, just up a little bit over 2%. Typically, in a decline like this, these type of instruments help you offset the losses on the stock side of the portfolio. It's a whole nother discussion as to the why, and that's beyond the scope of this week's video. Remember last Friday when the Dow was up 9%? In the weekend video, we said these charts, TLT relative to SPY, were basically saying nothing really had changed. This looks like a counter-trend move against TLT relative to SPY. This chart's dated Friday, March 13th. If we fast forward a week, the breakout held for TLT, and TLT outperformed SPY by 12.36% over the past 5 trading sessions. Similar situation here when the Dow was up 9% a week ago today on March 13th. Gold got annihilated in one day relative to SP low volatility. It underperformed SPLV by 9.52%, but this looked like somewhat of a retest look relative to this breakout, and we covered this chart last week. Still looks like a successful breakout. A week later, GLD outperformed on the daily chart SP low volatility by 8.32% and outperformed for the week. This is the weekly version of GLD relative to SPY that we covered a week ago, dated March 13th. This looks like a bullish breakout that said try to be patient with your gold positions relative to stocks. If we fast forward a week, GLD outperformed SPY by 14.43%. Similar situation here. Last week on March 13th, we said, not so sure about that 9% rally because for the week, GOVT government bonds outperformed SPY by 8.35%. That really doesn't look like risk on. If we fast forward a week, the breakout held and GOVT outperformed SPY by 17.88%. It's the title of a short takes post dated Sunday, March 15, 2020. Fed launches largest set of stimulus in history. So far, we seem to be on the right side of this curve until proven otherwise. We should keep in mind walking forward on Thursday, March 26th, which is a week from the day this is being recorded, we're probably going to see ugly initial jobless claim numbers, something that the market is aware of, but it's good for us to be aware of it as well. If the market rallies on Friday, or if it rallies on Monday, this topic may be what causes a counter-trend rally of more than one day to take place. That's to be determined. The text on the left is from a detailed report on the potential impact of the coronavirus. You can find it by Googling this title here where my cursor is. It talks about an intensive intervention package. That's all the steps that we're taking in the present day or the steps that we should be taking, including social distancing. It is possible those type of interventions will need to be maintained until a vaccine becomes available, and that could be 18 months or more. The market will also be keeping its eye on China, South Korea, and Italy to see what happens with the case rate in each country walking forward. This figure right here, 18 months, seems to align with the present day concern in the credit markets. There's a measurable statistic here, and this is a scary and rapid move. It's also possible 18 months is reflected in the stats that we're about to cover. The Bloomberg Commodity Index just fell to its lowest level since 1976. The Home Builder Group is now down 50% since February 20th. Typically in a time of turmoil, if you own TLT, IEF, and gold, and you have a lot of cash on hand, things are going to go relatively well for you. Not the case in the present day. It's been very, very volatile. From this week, TLT is on pace for the best and worst days in history this week. A gain of 6.5% in one session, a record, unprecedented. A loss of 5.4% in one session, unprecedented. March 16th, today was the worst percentage decline of all time for both the NASDAQ and the Russell 2000 Small Cap Index. If you follow along on Twitter, you're familiar with gaps. This is an incredible stat. SPY, the S&P 500 ETF, started trading in 1992. 3 of the 5 largest gaps in history came in the past week. Think about the number of trading days between 1992 and the present day, and we had 3 of the largest 5 gaps occur in the past 5 trading sessions. Has it been difficult for all market participants? You bet. 3 of the worst 10 days in S&P 500 history have occurred in the last week. Think about how many trading days there are in the S&P 500's entire history. Doesn't end there. Data going all the way back to the 1920s. Record never seen before, unprecedented, consecutive days with 4% swings. It's very, very difficult in the present day to think about the other side. Credit spreads are telling us that the other side could potentially be several months down the road, and it could occur from much lower levels. It's possible that the other side will occur more than a year down the road and occur from much lower levels. Emphasis on possible. But at some point in the coming weeks and months, most likely, since we've fallen so fast, evidence is going to start stacking up that says we're near a potential low. And it's important for us to be mentally, strategically, and tactically prepared when that day arrives. And when that day does arrive, it may be extremely uncomfortable to act. I can assure you, down here in March of 2009, very, very uncomfortable to take action in this area here. But this is the most favorable risk-reward point for the most part in the entire bull market. Credit spreads are telling us that we shouldn't be shocked to see additional closures and failures in the coming weeks. Hard data in the form of credit spreads is similar to the data that was present in the year 2000 and the year 2008. Is there anything else? Possibly. This chart is as of Thursday evening, March 19th. Depends how we close on Friday, but right now you can see weekly RSI is clearly, easily discernible below 30. This is the year 2001. Similar look here. This is the year 2008. Similar look here. And notice during the bullish periods, that never happened, and that never happened. This is not a discernible look. This is a tag and a move away. This is a tag and a move away. It is possible on Friday that this look corrects, but right now it's concerning. Anything else? Yes, you can pause your video player to review the details, but recent price action in the utilities sector, similar to July and October 2002 and November 2008. Similar to this period here, similar to this period here, similar to this period here, and this period here. Value line geometric index. Long-term breakout, February 19th, 2020. Same chart. Is now an incredibly concerning failed breakout. Once again, as of Thursday evening, the 4-week rate of change, negative 40.35%. That exceeds the 2008 case here. It exceeds the 1987 case. And basically, if we go back to 1982, this look here as of Thursday, once again in never seen before and unprecedented territory. Flexible, unbiased, and open mind. Why? The two similar cases here, this occurs near a wonderful entry point. Not the case here. When you see this, some ugliness still occurs for several months. Stocks versus bonds, February 19th, 2020, massive long-term multiple-year breakout. Also, similar breakout here. Looks similar to this point here and this point here. In the previous cases, really good things happened after that look in favor of stocks and against bonds. If we fast forward, we have another chart as of Thursday evening that has a very concerning failed breakout look. That's why we say things like this. When you get a bullish breakout, the longer it remains in place, the more relevant it becomes. The longer this failed breakout remains in place, the more concerning it becomes. Transportation index, major low in the stock market, breath thrust action here, bullish breakout, really good things happen. Major low in the stock market, 2016. Price action, very impressive in here. Nice bullish breakout. Similar setup here and here as of February 19th. But now, instead of having a look like this, we have a very, very, very concerning failed breakout look, and this is a daily chart. Very, very similar story here. Very long-term, multiple-year breakout taking place in the global Dow, February 19th. March 19th, very concerning failed breakout look. This chart can help with a flexible, unbiased, and open mind. 1987 case, similar to the present day. It was over basically at that point. That was an outstanding entry point. Now we're starting to see comparisons with 1929. Was it over in that case? No, not even close. Present day look here is similar to this look in 1987 and similar to this look here in 1929. The outcomes are basically polar opposites. And that's why we've been saying it's important for the market to stage some type of rally soon. Because if that doesn't happen, we start drifting away from this case. Clients and regular viewers know as of Thursday evening, this is not what a strong secular trend looks like. The longer the S&P 500 stays below the 200-week, the more concerning it becomes. Similar situation here. If we can hold the December 2018 low, the longer we can stay above that level, the more encouraging it becomes. Conversely, if we cannot hold this area here, it's possible we could move down to some of these areas here. That's all to be determined. This is an incredible amount of downside momentum. It is highly unlikely that it's going to dissipate in a few sessions. Even the best case scenario would most likely say a bounce and some type of retracement and or lower low. And that would be the best case scenario from a probability perspective. But as always, we'll take it day by day with an open mind about all outcomes. We could get a massive bounce with a look like this and still go on to make much lower lows. As of Thursday's close, we'll learn something either way. If we get a bounce, this could act as potential resistance. As of Thursday's close, March 19th, we would put this into the still concerning category. Clustering above this line is not what we want to see. This is what we want to see. Bottoming process, we want this to come down. Bottoming process where you retest and retest. Here comes down. That's not what we have yet. Not what we have yet. This is still a concerning look relative to volatility walking forward. After the shortest cyclical bull market in history dating back to the end of World War II and the fastest bear market in history, it's very, very easy to get off kilter mentally. Been doing this a long time. Everything on this list is basically just a waste of time. Experience says just try to skip all of this and move directly to all of this. I think it's probably fair to say if a 1987 type low is going to happen, the S&P 500 really needs to start rallying very, very soon. If it continues to plunge, we don't get a rally or a bounce on Friday, this is starting to become a lower probability event. Even if we get a bounce, it doesn't mean this is still alive. It just keeps it alive. Very, very easy to lose focus in the present day. Very, very easy to lose focus here. That would have been a big, big mistake. There are problems in the credit markets. Until the credit markets calm down, it's going to be very, very difficult to put in a sustainable low. There are still some similarities to the 1987 case, enough to help us walk into next week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.